Let's talk markets now with Joe Amato, President and Chief Investment Officer at Neuberger Berman, which has $515 billion in assets under management. Joe, great to have you with us.
Morning. Good to be here.
Obviously, second half there, you take a look at what you should be doing with your own portfolio, and a lot of people are wondering. And what happened yesterday's market was really interesting because it was like July 1st hit, and there was just a rotation out of the higher multiple sectors, out of tech stocks, out of the AI trade, and into the lower multiple sectors, which you can argue may be weak, whatever you want to call it, consumer discretionary names. You saw Target up 6%, Macy's up, the underperformers. Is that what we should be doing?
I think you definitely saw a bit of an unwind of some of the momentum. And if you look at how markets performed over the first half of the year, we started the year with a broadening out, and some of the other sectors like value and non-U.S. equity started to do well, and there was pressure on the top end of the large cap index. And then that bounced back, right? You've had some, resilient economic data, generally better rhetoric around trade. You had better earnings, so the markets bounced back pretty hard, but left behind some of those sectors like value and small cap. So you're seeing that rotation again. Our view is that's where the value really is, like rotating into value, into small caps, both of which particularly small caps, have really underperformed somewhat painfully the first half of the year.
How do you walk the line? Because by waiting, you have to have some exposure to the big cap companies, to the big cap tech stocks specifically. But at the same time, you want to go to where there is value in this market. And how does the context of an S&P at basically 6,200 factor into this here?
Yeah, on the large cap side, it's discounting a lot of good information, a lot of good news. And that's why we're more careful there. We're basically at target for large cap, but overweight small cap, overweight, non-U.S., where they've over the last number of years have underperformed, and that's where we think there's better value for the second half of the year.
Non-U.S. has been outperforming for a while now. So where do you still see value there, and which countries, which areas of the world do you like the most?
Well, you're seeing fiscal stimulus coming to Europe, finally.
Germany,
some of the actions that probably overdue for multiple years, particularly Germany, right? So we think that helps. You saw a weakness in the dollar, which certainly facilitated a lot of that capital flows outside the U.S. And the other area that we really like is Japan. So we've been bullish on Japan for a number of years on the back of very, very strong improvement in corporate governance and better returns for shareholders.
You mentioned the weak dollar, so we have to talk. It was the worst first half of the year for the dollar since 1973. It was down. The dollar index was down 11%. I'm wondering how much of that factors in for you, and if you foresee more dollar weakness. It seems like all the factors are out there to say that the dollar will continue to weaken.
I think you've seen probably the worst of it, but I think we still see the dollar grinding. And if the Fed does end up reducing rates at some point, we think there'll be 100 basis points reductions over the course of the next year, whether it's this Fed chair or the next Fed chair. And I think that will probably put a little bit more pressure on the U.S. dollar.
So is that good? Is it good for U.S. multinationals? There's research that it is good for U.S. multinationals, but in the long run, maybe it sort of is a wash. I
think it's a long run, it's a wash, but I think it is one of the reasons why we're overweight developed markets outside the U.S. is because of that sort of grinding, softening dollar that we see over the course of the next probably several years.
Yeah. What is a good multiple? What is a fair multiple for the S&P 500, which is at like 27 now?
Yeah, I think you have to dissect it a bit, right? Because you've got the multiples at the top end of the index, which are extraordinary companies that have had amazing growth characteristics over the last number of years, right? That are trading at a premium to that, and you've got the rest of the market. So, we're more focused on the rest of the market, where multiples, while not necessarily screamingly cheap from a historical standpoint, I think offer more value.
So the other multiples, so we're talking, consumer discretionary, for instance, is what, 22 or something like that. There's a catch-up here, is basically what you're saying for the second half of the year.
Yeah, well, I think in the areas that have generally either underperformed or were left behind a bit, I think you'll see a bit of a catch-up. And part of this is, you've talked a lot this morning about the tax bill, about some of the other pro-growth policies that may be coming out, and I think that will do well for those, whether it's as often is called the 493 of the S&P 500, or probably more significantly as you get into small and mid cap, right? Those pro-growth policies, less regulation. I think that bodes well.
So we mentioned the context of the S&P 500 at 6,200 right now. So is it churn, and so the rest of the 493 move higher and the tech goes lower, or is this within rising, the rising tide lifts all boats kind of thing when you talk about the growth in the tax bill.
I think the top end of the index is going to grind it out.
Yeah.
I think you're going to see a bit of a trading range, and our expectations you'll see catch up in some of those other areas of the markets.
Banks are definitely not catch up, but they're in favor by institutional investors. So where do you stand there? And there is also a large cap versus a mid cap and small cap component trade to the banks also, where a lot of people are recommending now to move down the cap scale within banks, since large cap banks, like so many other large caps, are fully valued right now.
Well, in financials, you've got the prospect for less stringent regulation. Right? You saw yesterday in terms of stress tests, right? So there may be capital returns, less regulation, and with an improving economic outlook over the next number of years, I think that generally bodes well for financials.
We've hit a lot of ground, but tariffs, we haven't touched that. You haven't mentioned it. It hasn't crossed your lips in this whole conversation.
Yeah, it's,
what kind of sort of wild card is that for your
I think
basic
you've got
optimism?
some headline risks for next week, right? You've got a pause. The president has talked about not extending. Secretary Besson has talked about for those countries that are negotiating good faith, you may see an extension. It is hard to get deals done, right? There's a lot of talk about getting a deal done with Japan. They've got a big election coming up at the end of this month, right? We don't expect to deal with Japan prior to the upper house elections coming at the end of the month. But it seems like there's engagement going on, but it's unlikely you're going to see a lot of deals for July 9th. And then you've got also China looming in August. So that's something that we're watching closely. You know, I think the rhetoric has been better over the last couple of months, and that's improved the sentiment in the markets. But that's something that there's definitely headline risk there.
And what have you seen in terms of flows and just sentiment amongst clients, particularly individuals? Are they putting money to work, or are they pulling money out?
We saw an interesting dynamic with individual investors during the March-April periods, where it was almost like institutional investors were more panicked about the tariff situation and whether they understood the full ramifications of it. Retail actually was buying into that drawdown, having seen maybe some of the benefits of buying on the dip over the course of the last number of years. So we didn't see that level of panic at the retail side, which was interesting and I think encouraging.